What's up guys, it's Dennis. In today's video, we're going to go through some of the reasons why you might not want to use an HSA and why ordinary insurance plans may be more beneficial for you. HSAs have been growing in popularity in recent years, and according to this Devenir market report published in March of 2021, there are over 31 million HSA accounts. The report also found that more people are contributing to the HSA than are withdrawing down in the HSA, which shows that overall people are growing their HSA accounts. This prompts the question on whether or not you should open up an HSA account and if it's right for you. By the end of this video, I hope to give you a solid understanding of whether or not you should be opening up an HSA. We'll go through some specific examples and why you might want to consider regular insurance instead of an HSA. Alright guys, before we dive in, we're at that fun part of the video where I beg and plead with you, please like the video. It really does help. The YouTube algorithm does push the videos much higher up, and although it seems like a really small thing, it would do me a huge favor if you could just do this one small thing. While you're at it, don't forget to subscribe to the channel and smash the notification bell so that you get notified of all my latest videos. Okay, so in order to have an HSA, you need to be enrolled in what's known as a High Deductible Health Plan, otherwise known as an HDHP. As the name suggests, high deductible means you need to reach the deductible before the plan starts covering at 100%. According to healthcare.gov, that means you'll be on the hook for a minimum of $1,400 if you're an individual and $2,800 if you're a family. Now, I'd said minimum. What about the maximum that you could be paying? Well, the maximum for an individual is $7,050 and for a family, $14,100. That may sound like a ton of money, but the reality of it is that your insurance will probably give you a different amount within that range. As an example, I'm on such a plan and my limits range from $2,500 to $5,000. So as long as it's within the minimum and maximum, that's what really counts and qualifies it as a high deductible health plan. Now, this could be a significant amount of money that you need to fork out. And while many employers do contribute towards HSAs, it still means that you could be on the line if you're not able to cover some of the medical expenses that you may incur earlier in the year. Unlike an FSA, where you get the entire annual amount that you're going to be contributing upfront, the HSA is more like a bank account. So the money that you put in is yours and whatever's there is available for spending. If you were on regular insurance, depending on the number of factors, the average monthly cost for an employee for individual coverage is just over $100 per month, and it's about $500 per month for a family. That being said, employers generally pick up about 70% of the total premium, so what you're seeing is only a tiny portion of the healthcare cost. An HSA is a health savings account, and like the name suggests, it's effectively like a bank account, and you're meant to be putting money away into that account to save up for future medical expenses. This means that you should be constantly saving money each and every single month as you're contributing towards your HSA. However, with inflation currently running rampant through the economy, many consumers are finding that their dollar isn't going as far as it used to. And if you're someone that hasn't received a significant raise or bonus in a long time, you may find that that's a lot of money to be forking out over and above everything else. With added pressure of having to fund an HSA account, that could be just too much for you, and it could be the straw that broke the camel's back in terms of your personal finances. So you may not have the financial resources to contribute to an HSA. It could be potentially disastrous if you enroll in an HSA early on and then the very next month you get hit with insane medical bills. You probably are not going to have the money to contribute to it off the gate. So you definitely want to have some money saved up so that you're able to cover any medical expenses as you switch to an HSA. Speaking about being a pinch, an HSA works just like a bank account, as I mentioned. Now, what that means is you're able to withdraw money as in when you please. You just literally ask your custodian to initiate a withdrawal and they will send that money straight into your bank account. Now, an HSA is designed to be used for medical purposes. And as a result, if you withdraw money and you use it for non-medical purposes, you can find yourself in a little bit of hot water as you're going to have to pay interest and penalties. If you withdraw from an HSA after the age of 65, it's not that bad. You're not going to get hit with any penalties because you've reached retirement age. However, you'll still get hit with any income taxes as a result of that withdrawal because the money is not being used for medical purposes. If you do it before you're 65 though, you're going to get hit with a 20% penalty, which definitely doesn't make it worthwhile to withdraw it earlier than that. So how can you withdraw the penalty? Well, only withdraw money that you actually need for medical expenses that you've incurred. If you're not sure what expenses are eligible, I made a video on this exact topic. Click the link above to go watch that video and see what expenses are actually claimable. If you're still not 100% sure, the best option is to check with your HR department to see what they say. However, you can also check out publication 502 that was published by the IRS, which really helps break down what expenses are eligible. Now, what happens if you do make a mistake? Say you do withdraw some money from the account and you use it for non-medical purposes. Well, you may be able to return the funds back into the HSA account. And in fact, I did this myself, so I know it definitely is possible. However, you have to provide clear and concise evidence as to why you made the mistake and basically true up the account to what it should have been. An HSA account is an extremely tax-effective account. In fact, HSAs are triple tax advantaged if used correctly. However, one of the caveats of that is that it does require quite a bit of admin, and you need to keep all of your expenses in a neat, organized manner so that you're able to refer to them at any point in time. As I mentioned above, you can get hit with taxes and penalties if you make invalid withdrawals, so you definitely don't want to go this route. And if you're the kind of person that just doesn't like admin, maybe an HSA is not the best account for you. Now, while I mentioned a bunch of reasons to avoid an HSA, I do think that HSAs are really great accounts. And in fact, I have an HSA and I still use one, and I still plan to use one for many years to come. The reason being is that I use it as a retirement vehicle. Now, if you're interested about this, I made a video on this exact topic, so you can check it out. I'll put the link right over here. So for you guys that watched the end of the video, thank you for watching, and I'd love to know, are you considering an HSA? Is it right for you? Let me know in the comments below. And finally, thanks for watching to the end of the video. If you did enjoy it and you learned something, I'd really appreciate a like and a subscribe for the channel. Have a great day.